Hi guys, good afternoon. It's Monday, August 18th. I want to go over a few things today. I've been talking about how what is going on with the debt, the $37 trillion, it can't be sustained even though they passed the big ugly bill. Number one. Number two is it's increasing to 42 trillion, which means that they're going to be putting more money into the stock market. Nobody knows what that means. I will explain that. And what it means after it can't be added anymore, meaning that there is no additional big ugly bills, and the Federal Reserve cuts and additional stimulus basically exhausts itself because we are hitting that threshold. And three, what does that threshold look like when it hits that ceiling threshold, right? And we're close to it because 37 increasing to 42. How long can this kind of basically national debt train continue? And it will slow, and then once it starts slowing down, people will realize, and basically all the benefits from July 4th big ugly bill have been already extracted into the stock market already. So the fourth thing is people have been asking, okay, so what's going on with the stock market? Why is it at all-time high? It is because of the big ugly bill, just so you understand in layman's terms. And five, what happens next? So what happens next is that in 2026 to 2027, during that time, early 2026 to 27, and by the way, this is all in the happening before the midterm. So we can see an acceleration of this point because there's nothing that's going to be passed for the most part of stimulus. So we're going to probably see this in early 2026, and it will influence and impact the midterms. Okay, in addition to everything that's going on right now. So when I say 2026 to 27, it may continue an extended period of time, kind of like the 2007, 8, 9, because it continued for most of 2008 into 2009, and we hit a bottom in March of 2009 as far as the stock market is concerned. In this situation, number five, is that we could see a drawdown, a decline or a drop, whatever you want to call it, of 36 to 50 some percent. And that's pretty significant because that will ripple through not only everything in our lives, housing market, businesses, confidence, not only in the United States, but globally. And so this is not unique to the United States. This is all the same throughout the whole world. They've essentially done the same thing. This is all tied. The correlation is number six is 93%. So R square is 93%. Okay, so 100% means it's 100% certainty. So there's only 7% variance of these other factors. 93% is correlated from 1981 to present day 2025. That when you see national debt increase from 1 trillion to 37 plus trillion dollars, that you see the stock market increase as using S&P 500 as the reference point. So these are the points I want to make sure you understand. Right now, our market capitalization of our stock market to GDP and debt is 250%. Okay, 250%. And I will show you this chart before I start. So let me just show you this. So here's the debt. Okay, market cap to GDP. Okay, here's the market cap just escalating, and the GDP is not keeping up pace. So that is froth right there, and you can see it right here. This is the chart, market cap to GDP. So we saw the bubble, okay, 99, and then it crashed because here's the median, by the way, 100%. So it hit 150, and then it crashed because that was the bubble. And the same thing happened here. So it increased above 100, and then it crashed. So from here, this is all debt that we borrowed, and so all stimulus. So from the bills, from the Fed, from these cuts. And so when we got here, we're at 250 right now, guys. So here is the norm, the line, okay? and we're at 250. So guess what happens? Are we going to pass more $1 trillion stimulus? The market says so. And that's not going to happen. There's no more money left. And so here is the reversion to the mean. So if you look at this, okay, that's why I said 2026, because this is 2026, right? 26 and 27. There you go. That's the 50%, because we're here now. Okay, and this is where it could be. That's the 50+%. And here is just the PE. So if you look at the PE, median PE is 16. That's 3,500. So that's how you get the 36% decline. And then if you go down to this level, which is like the 10, 11 PE, okay, that's how you get the 50%. So however you look at it, are you looking at it on a PE basis, or are you looking at it based on the market cap to GDP? Because right now the market cap is just going up, and you can say and make excuses that it's for various reasons, including AI. That's fine, that's fair, but I'm just telling you, AI is not going to be paying down debt. So if debt keeps on increasing, we have a problem here because we're in bubble territory. Like I said, 150 is bubble territory. We're at 250. Fair value is 100. Fair value is 100. Bubble territory is 150. We're at 250. So let me just, so I gave you my commentary, and let me just, I put this thing together. I checked all of this with ChatGPT, and so let's read it out loud, and then you could see it more articulately in a concise way than maybe I have just right now. Okay, so just stand by.
CNBC's complicity in America's debt-driven Ponzi market. 1. The CNBC pitch, selling the illusion. Recently, a CNBC contributor aired a segment declaring that because living expenses are rising, Americans should put their money in the stock market to generate returns. It sounded like friendly advice. In reality, it was a sales pitch for a system that CNBC knows is built on debt, not fundamentals. From 1981 to 2025, the U.S. national debt exploded from under $1 trillion to $37 trillion. Over the same period, the S&P 500 skyrocketed more than 40-fold. Statistical analysis shows a 93% correlation, R superscript 2, between national debt and the S&P 500. Nearly all stock market gains in this era can be explained not by corporate earnings or innovation, but by Washington's willingness to run deficits and the Federal Reserve's willingness to inject liquidity. CNBC knows this correlation, but they don't disclose it. Instead, they encourage viewers to buy into a system that only rises because the government keeps expanding debt. That is complicity. 2. Ponzi-like dynamics. By definition, a Ponzi scheme sustains itself with new inflows of money. Collapse comes when the inflows stop. The U.S. stock market functions in a similar way: new inflows, deficit spending, tax cuts, and Fed stimulus. Distribution. Corporations recycle liquidity into buybacks and dividends, enriching asset holders. Dependency. The system only works as long as debt grows. Fragility. If Congress stalls or debt buyers lose faith, the cycle falters. This is not capitalism in its pure sense. It is a policy-engineered wealth machine that depends on debt. Expansion, with CNBC acting as its promotional arm. 3. CNBC's role, from journalism to cheerleading. CNBC is not neutral here. They're promoting, not reporting. Instead of warning viewers about the 93% correlation, they sell the idea that stocks are the only way to keep up with rising costs, cheerleading policy bubbles. Every tax cut, beautiful bill, or Fed rate cut is hyped as strength, when in truth it's just more debt inflating asset prices, withholding risks. CNBC knows that the market cap to GDP ratio is at 250%, historically bubble territory. They know that if it reverted to its 100% long-term norm, the S&P 500 would fall by 50%. They know that a return to fair value multiples, 16xp would mean a 36% drop. But they do not tell viewers this. And here lies the deeper complicity. CNBC never tells investors when to get out. They didn't protect viewers in 2000 when the dot-com bubble burst. They didn't protect viewers in 2008 when the housing bubble collapsed. They didn't protect viewers in 2020 when the COVID crash struck. Instead, they cheered each rally back, knowing full well that stimulus was coming. Their job has become to keep money flowing into the system, not to warn when it's time to step aside. 4. The consequences for ordinary Americans and global investors. When CNBC tells viewers to buy stocks to beat inflation, they are urging ordinary Americans and, by extension, global investors who watch U.S. markets as the bellwether to buy into a bubble at peak. Valuations, without disclosing the systemic risks, a reversion to long-term average PE multiples 16x would imply a 36% decline in the S&P 500, a reversion to historical market cap to GDP 100% would imply a 50% decline. Those who buy now, late in the debt cycle, will be left holding the bag when fiscal expansion slows or debt confidence cracks. For global investors, the stakes are just as high. U.S. equities set the tone for global capital markets. A 40 to 50% drawdown in the S&P 500 would not stay contained within America's borders. It would ripple through Europe, Asia, and emerging markets, pulling down pension funds, sovereign wealth portfolios, and retail investors worldwide. CNBC's daily message is simple: put more in. But if stimulus hits a dead end, either through a gridlocked Congress or a Federal Reserve that runs out of room, CNBC itself becomes further exposed as part of the Ponzi. At that point, they cannot help investors, despite promising every day that they can. 5. Why the illusion hasn't broken yet. Unlike a private Ponzi, the U.S. government enjoys unique advantages: the dollar's reserve currency status, treasuries as the global safe asset, a central bank willing to bail out markets at every crisis point. But these are not infinite advantages. As the July 4th, 2025 beautiful bill fades and gridlock returns to Congress, the inflows that powered the 2025 rally will dry up. The Federal Reserve can cut rates, but Fed-only support has never created lasting rallies without new fiscal fuel. That's why the next downturn could emerge as early as 2026. 6. The verdict: complicit, not credible. The U.S. stock market has been carried by debt for 4 decades. CNBC knows it. They know the 93% correlation. They know that debt, not earnings, explains the market's trajectory. They know that valuations are in bubble territory and that a fair value reset implies a 36 to 52% decline. Yet they continue to tell ordinary Americans to add more, never to step aside. They failed to protect investors in 2000, 2008, and 2020. And they cannot protect them now if stimulus hits a dead end. That makes CNBC not just a cheerleader, but a complicit participant in sustaining America's debt-driven Ponzi market. 7. A call to investors: look beyond CNBC. If CNBC cannot warn you, then you must warn yourself. Investors, American and global alike, should look to independent valuation signals, not promotional television hosts' market cap to GDP ratio. Anything above 150% is historically bubble territory. Today we sit near 250%. Cape Shiller PE ratio historically averages 17, 18. Today it is in the high 30s. Debt trajectory: if national debt expansion slows due to Congress gridlock or waning Fed tools. Warnings before equities crack. Crack. The message is clear. Do not rely on CNBC to tell you when it's time to step aside. They will never do it. They will only tell you to stay in, even if it means riding into a 36 to 52% decline. Global investors should take note. The world's benchmark market is built on debt expansion. If that engine stalls, the US stock market, and by extension the global financial system, faces a reckoning. Chart 1, Chart 2, Chart 3, Chart 4, Chart 5.
Okay, so we didn't need the last part, but here are the charts that I mentioned before. Okay, so the chart 1 is U.S. national debt to S&P, and you can see right there why the correlation is 93%. This is from 1981, and that the reason why I use 1981 is because of Ronald Reagan. Okay, so look at this. Correlation is not even 93. It's probably like 97, 98, and then it breaks apart a little bit. Okay, and then it continues, and then here in 2007 S&P declines because of the crash, and then we have to borrow, and then it accelerates, and then the market catches up with it. Not only catches up with it below, okay, but then it exceeds it. Look at that. It breaks it because it's anticipating more. That's even before the 2020 COVID, and then that's where we are, where the market dropped and then increased, and then they knew that there was going to be more stimulus, and we're exactly here. Okay, so they're going to forecast it going forward, meaning that we're already at 37 plus, but the market is high above it because this line, the red line, is actually accelerating further up. So I don't have those charts in this, but I've already generated that, and so those charts show 42, 45, 50, 55, 60 trillion dollars of national debt. So status quo is the S&P does rise slightly, but it's not sustainable. Okay, so here it is again. U.S. stock market versus GDP. So if the stock market, you can see it's below, okay, and then up for a little bit below, and then it just takes off, okay, it just takes off, and so that's fine, okay. The only problem here is just look at this. So in the same period from 1981, it's below. So this is undervalued, overvalued, and then the crash, and then overvalued, meaning fair valued, and then undervalued because of the market. And that's why this is basically March of 2009, and then it just never, from to that March of 2009, has never broken 100 again. So you can see many times it's broken 100. 2008, 9, from the bubble of 2000. Okay, these are the times there were good buying opportunities, but now look at it, just above it's 250. It's not, and you can say various reasons, including AI. That's fine. Crypto, fine. Good luck to you guys on those fronts. And so here is number 4, as I mentioned, reversion target, which is the current is 5,300, so 2334, 2,334. So you can just do the math, okay? That's significant drop. And then if you use the 16 times, or you use the 250, whatever multiple you want to use, is that valuation does matter. It may not matter to you. It may not matter to the people that are promoting it, in this case CNBC, but it does matter for the people that are outside the United States that are also investing in this debt that we have, because this national debt is many international players. So once this national debt continues to increase and they don't buy anymore, then at the end of the day, we're going to have to pay that higher interest for it, and we can't afford it. We can't afford it. So the reason why I named this CNBC is because CNBC is complicit in this, and then we look at and focus on this. And so we already know that we, on the left, we have MSNBC. On the right, we have Fox. And so for the markets, who do we have? It's CNBC, guys. Okay. And so it is not, as the analysis shows, in an independent an arbiter of helping you with things, even though it may seem like it. This is it's the evidence is it's overwhelming. Okay, so like I said, I ran this through ChatGPT to confirm it, and so nothing that I've said is there's nothing wrong with what I've said, what I put together, and like I said, it is confirmed by ChatGPT, just as a safety check. Okay, you can use it for whatever you want it to, but I am just explaining to you that this situation is not going to end very well for us, and this is going to be more severe than 2007, 8, and 9 in the United States and outside the United States globally. Because when this happens in a bubble, when you do have a crash, back to whatever the level is, it doesn't necessarily have to be 100% level, right? So this 250 doesn't need to go to 100%. It just needs to decline. It did decline from 150 to below 100. Okay, it did increase from 125 or whatever it was to below 100. So if this declines from 250 to 100, is my point, it's a 52% decrease in the S&P. Overall market, but S&P would be probably 52%, maybe a little bit more, but it's going to be that. That's significant. And by the way, we didn't even see that. And we don't know what happens after that, because our debt is here. Back then it was here. Okay, so just so you understand, our debt, national debt in trillions, was about like 7 or 8. Okay, so if you add stimulus as we did, that's fine, even though maybe it wasn't fine at the time, but it's fine relative to now. We're at 37 and we just added another 4 or 5, so we're already at 42 trillion. 42 trillion is not 7 or 8, ladies and gentlemen. Okay, so I want to make sure you understand the difference between those two components. And if you're okay with that, then that's fine. If you're not okay with it, you can do something about it. And I can't tell you what to do. I've just given you the information on telling you what is happening and what is going to happen in short order. In the next few months to 6 months, this will start playing out as we get into the midterms, especially. And this concept of what is happening in the market will also play out, because everybody's in the market. It doesn't matter, and has an impact on the market. And as we saw in 2007, 8, 9, the reason why President Obama most likely got elected versus McCain in 2008 was because of the crash of the market, FYI. So guess what? Who's responsible for this? Taco is responsible for this. MAGA Republicans in Congress, both House and the Senate, are responsible for this. To be fair, it is also the Democrats, because they've also proposed and passed stimulus bills, and nobody wants to talk about that. So in light of all that, we need to vote for people that address this and AI and many other issues, because this is an existential threat. It is the debt. The debt is an existential threat to us, and the coincidence is that the Freedom Caucus from the Republicans, MAGA, they've been talking about the debt, and then they vote for more debt. So they're clowns. You can't trust them. So the debt is an existential threat. Okay, climate change is an existential threat. Taco is an existential threat. Rule of law is an existential threat. When you have these things and they're literally up for ballot, so you need to vote for candidates that understand this. AI is an existential threat, because you can't just allowing the net national debt to appreciate as it is. They're allowing AI to appreciate as well. And it will become an existential threat. As we said previously, that AI will basically cut 63 million jobs. Currently, we have 163 million Americans employed. Over the next 25 years, based on ChatGPT, it will cut 63 million Americans. That's 37 to 39% of Americans alone. Globally, it's more than 300 million when you incorporate AI and its tools, including automation, etc. So when you have 63 to 300 million jobs that are going to be cut, what we're focused on how we can make money in the stock market today, which is bubble. It's a bubble territory, and it says it right here. 150% is bubble territory. So if 150% is bubble territory, as it was in 2000, we're at 250. So what are we talking about again? Because we're 100% above bubble territory because the fair value is 100. It's common sense. Nobody has pointed this out, but CNBC knows this, Wall Street knows this, Bloomberg knows this. Fox is not so smart, but the people that earn money behind Fox, like Rupert Murdoch, knows this. Okay, many people know this. The people on TikTok and social media don't know this. Okay, if you didn't work on Wall Street like I did, you may not know this. And the only reason why I put this thing together is because I want to make sure that you understand this. Because if you don't understand this, it is going to be similar to what had happened in 2007, 8, and 9. And you have to be prepared. And you should be prepared. And you have plenty of time because it's 250 right now. Okay? Thank you, guys.